It's not just FEMA monitoring the fallout from Milton and Helene. Cat bond investors are also paying attention because those bonds issued by insurers and reinsurers transfer risks of a catastrophe to the capital markets, offering payouts if a disaster doesn't occur, but sometimes not doing so when it does. Returns dropped sharply in recent years when we had major hurricanes, like in 2022. Yields skyrocketed last year after the impacts of Ian were felt and offered payouts of nearly 20%. So what happens now with the effects of Milton, which could be quite substantial? Joining us to talk about that is Jeffrey Davis. He's a portfolio manager and partner at Elementum Advisors, which specializes in insurance-linked securities. Jeffrey, it's good to see you, and I'm sure people are shaking their heads a bit, hoping maybe for a better season than it looks like they're going to have.
Yeah, hi, Kelly. Thank you for having me on. I just want to start by recognizing the millions of people that were impacted by this event. Our thoughts and prayers go out to them. In terms of the potential insured loss and economic costs of this event, we have industry experts that are currently projecting insured loss anywhere from 25 billion to 70 billion plus, with an economic loss that is likely to be meaningfully higher. And the way that these losses are estimated so soon after an event is that experts are able to run a simulation of Milton's path and storm characteristics to come up with this preliminary estimate. And while it is a good guidepost, it does remain uncertain so close to the landfall just 24 hours ago.
Right.
In terms of the cap bond.
Go ahead. Well, if you can kind of just tell us what this is going to mean for returns on cat bonds. This asset class has grown in size quite substantially. You know, it shattered records over the past year with 12 billion in new transactions, a total size of 45 billion. So, you know, small in the grand scheme of things, but growing quickly, even after what happened in 2022. And what's going to happen to people? These are 3 to 5 year maturities. Correct me if I'm wrong. What happens to those yields that people were hoping to get now?
Yeah, absolutely. So the duration on the cat bond market is actually just less than 2 years. So it is a short duration product. We do expect that there will be a drawdown similar to the graphic that you had recently shown, like Hurricane Ian, where it was a 10% drawdown. Hurricane Irma was a 15% drawdown right after the event. Now, both of those drawdowns did subsequently recover as more information became available. It does take time to sort through the expected costs of the event. And so there is a wide range of uncertainty in the market. And the reason for that is, practically speaking, on the ground, the priority remains with the first responders who need to go help those that may not have evacuated and been in the storm's path. And it does take time for the homeowners to get in there and the insurance companies after that, once the impact areas are stabilized, to come up with a more accurate cost estimate. And so that's why you see the sharp drawdowns after events of this nature. Right.
So let's say I'm a pension fund. A lot of these are institutional managers. And if it's a 2-year product, let's say $1,000 par, it's going to yield, I don't know, 10%. Now that Milton has hit with the damage that we expected to have, does my 10% return get cut in half?
So if you think about the supply-demand dynamics and the reason that the catastrophe bond as well as the insurance-linked securities market exists in the first place, is it provides capital from the global capital markets to help insurance companies pay claims after events such as Milton. And so the supply of capital is going to be pulled down as insurers draw on it to pay claims from the event. And that is naturally going to increase the overall yield in the market. If you started in kind of the low teens in terms of the overall yield for the catastrophe bond market, that is going to go up, but it is too early to say, given how close we are to the storm, exactly what that impact is going to be. The market is priced on a weekly basis. And so tomorrow we will get the first look at the Swiss Re Cat Bond Index following the storm. And that will ultimately tell us a little bit about where yields are likely to go after this event.